Markets hit a major psychological shift today, as the S&P 500 and Nasdaq both turned negative for the year. This everything shock was driven by a rare collision of factors: a surprise contraction in jobs, a sudden spike in oil, and emerging friction in the AI expansion. Today's data triggered a major psychological shift as both the S&P 500 and Nasdaq turned negative for the year. This broad concern follows a rare collision of macro shocks, an unexpected contraction of 92,000 in February payrolls, and a surge in oil past $90. Reports from Bella and Unrivaled Investing highlight that the energy complex is seeing its largest weekly gain in decades, while Alpha Trends notes the Nasdaq has now lost key technical support. The latest data triggered immediate concern across asset classes today. Reports from Bella and Unrivaled Investing show that February non-farm payrolls unexpectedly contracted by 92,000, a sharp reversal from the growth analysts expected. Simultaneously, the effective closure of the Strait of Hormuz has halted roughly 20% of the global oil supply. This supply shock pushed prices past $90, marking a massive weekly gain for the energy complex. This environment is forcing a rapid reevaluation of the Fed's path, with oil surging past $90, marking its largest weekly gain in decades. The Nasdaq has lost technical support and is now eyeing its 200-day moving average. 42 Macro suggests the central bank risks a policy error by maintaining restrictive rates, as energy shocks accelerate the shift toward a growth risk framework and a long-term economic drag. The market is now forcing a rapid reevaluation of the Fed's trajectory. 42 Macro notes the central bank may be committing a policy error by keeping rates restrictive even as the economy shows clear signs of cooling. It's a fundamental regime shift. We're moving past the bad news is good news phase and into a strict growth risk framework. This suggests that previous market pricing for a swift de-escalation of macro pressures is likely no longer valid. Energy costs are accelerating this regime shift. Nana reports that WTI crude broke $90 after an Iranian attack on a tanker near Kuwait. Bella notes that this conflict is transitioning into a long-term economic drag, rather than a quick resolution. This suggests that previous market pricing for a swift de-escalation is no longer valid. While headline jobs data appeared weak, the underlying structure of the labor market is shifting. 42 Macro characterizes this as an AI-driven jobless recovery. As shown here, structural productivity gains are allowing firms to maintain economic output without the usual levels of hiring. This shift is occurring alongside growing fiscal pressure, with the U.S. budget deficit expanding to 6.7% of GDP. We are also seeing a change in labor supply internals. Native-born supply has increased by nearly 1 million, while foreign-born supply decreased by roughly 600,000. These systemic risks are intensifying against a backdrop of significant fiscal and demographic shifts. The U.S. budget deficit has expanded to 6.7% of GDP, already surpassing 2024 levels. We're also seeing a stark divergence in the labor market. Native-born labor supply increased by 1 million, while foreign-born supply contracted by 600,000. These structural pressures are creating the friction we're now seeing play out in credit and infrastructure. Systemic risks are starting to surface in the credit markets. According to Unrivaled Investing, BlackRock has capped redemptions on its $12 billion corporate lending fund after withdrawal requests reached 9%. It's a significant warning that liquidity is thinning out in the private credit space. Friction is starting to appear in AI infrastructure. According to reports cited by Nana, Oracle and OpenAI have halted a major data center expansion in Texas, citing shifts in both financing and demand. However, Marvel is providing a strong countersignal. They just reported record revenue and a 98% jump in net profit, suggesting that the demand for AI-specific hardware remains robust despite these infrastructure hurdles. For risk management in this high volatility regime, Investors Business Daily suggests focusing on stocks with an average true range of 4% or lower. We are applying that defensive lens to several key watch points for the week ahead. Costco remains a staple after beating both revenue and earnings estimates, while Ondas is gaining traction with a new $20 million federal contract for autonomous border protection. We are also tracking the massive $148 million insider buy at Trade Desk, which signals strong internal confidence despite slowing growth. Finally, keep an eye on oil technicals. It is looking overbought, with a potential pullback toward $95 expected early next week. To navigate this volatility, Investors Business Daily suggests filtering for defensive setups using an average true range of 4% or lower. On the watch list, HCA is showing positive divergence, holding up well even as the broader market slips. We're also tracking Marvel, following its strong ASIC guidance and long-term growth targets. Finally, keep a close eye on the Nasdaq 200-day moving average at 588. A break below that level could trigger further systematic selling. We're seeing a definitive shift away from growth chasing toward volatility filtering. Looking ahead to next week, the Commerce Department's Robotics Roundtable on March 10th is a key event to watch for potential policy tailwinds in the automation sector. You can find the full list of sources and citations in the description. Subscribe for your daily high signal market recap.